One of the first decisions you will make when applying for a mortgage is whether to choose a fixed rate or a variable rate. The difference affects your payment stability and your total cost over the life of the loan. Here is how each one works and how to decide. A fixed-rate mortgage locks your interest rate for the entire term of the loan, typically 15 or 30 years. Your principal and interest payment never changes. If rates go up, you are protected. If rates go down, you do not benefit unless you refinance. The predictability of a fixed rate is its biggest advantage. You always know exactly what your mortgage payment will be. A variable rate mortgage, also called an adjustable rate mortgage or ARM, starts with a fixed rate for an initial period, then adjusts periodically based on a market index. A 5/1 ARM, for example, has a fixed rate for the first 5 years, then adjusts every year after that. The initial rate is usually lower than a comparable fixed rate, which is the main attraction. The risk of a variable rate. If market interest rates rise significantly after your fixed period ends, your payment can increase substantially. This is what created financial difficulty for many homeowners in previous rate environments. When does a variable rate make sense? If you are confident you will sell or refinance before the fixed period ends, the lower initial rate saves you money with limited risk. For example, if you know you are moving within 5 years, a 5/1 ARM at a lower rate could save you $200 to $400 per month with no exposure to the adjustment risk. When does a fixed rate make sense? Almost always for long-term owners. The certainty is worth the slightly higher initial rate when you plan to stay for 10, 20, or 30 years. For most first-time buyers planning to stay in a home long-term, fixed rate is the safer, simpler choice. Subscribe and come back tomorrow. How much house can you really afford?